Never be afraid to start small and never fear humble beginnings. This is the motto of Dr. Chia Song Kun, the founder of QL Resources Berhad. A very good morning to distinguished judges, ladies and gentlemen. Selamat datang, welcome to Malaysia. These are my team, Gabriel, Vivian, Jane and Jeremy. I'm Kylie. We are from University of Malaya representing Malaysia. Today, we are here to share our investment view on QL Resources Berhad. QL is a company listed on Bursa Malaysia with a market cap of $850 million. It is a leading integrated resource-based agricultural player in Malaysia, operating three segments, namely the poultry, marine, and palm oil. The poultry segment involves the production of eggs, day-old chicks and broiler, and animal feed trading. Today, QL is the second largest eggs producer in Malaysia. The marine segment entails the manufacturing of surimi, surimi-based and fish meal products. QL is the largest surimi producer in Asia and also the largest surimi-based products and fish meal producer in Malaysia. The third segment is palm oil, which involves the plantation, milling, and biomass. More than 90% of QL plantation land banks are located in Indonesia. Of the three segments, poultry is the main earnings contributor, accounting for more than half of the group's net profit. QL operates in more than 10 sites, with its home base Malaysia contributing 96% of the group's earnings. QL is replicating its Malaysian business to Indonesia, while in Vietnam, the business is limited to only poultry. Now, let's catch a glimpse on our presentation today. QL's earnings grew at a staggering pace of 21% net profit CAGR over the past 12 years since its listing in year 2000. Clearly an impressive feat. The strong earnings growth has also led to the tremendous increase in its share price for more than 10 times post-listing and has recently reached an all-time high. Going forward, we expect QL to register positive earnings growth, especially with its recent expansion into Indonesia. However, we expect the growth momentum to decelerate off a high base. This, we believe, could jeopardize the premium valuations that is accorded by the investors. Indeed, ladies and gentlemen, all that glitters is not always gold. Considering all these factors, we initiate coverage on QL Resources Berhad with a non-consensus sell with a target price of 275 ringgit. And this implies a 13% downside. In short, QL has good growth prospects, but we expect the earnings growth to decelerate off a high base. The stock is overvalued. Next, my colleague Vivian will explain further on the earnings.
Thank you, Kylie. Following a staggering net profit growth for the past years, we forecast earnings to slow down in coming years. In arriving at our forecast, we have considered the following factors, which is best illustrated by a simple SWOT. We have identified strengths like strong management track record, integrated value chain, and dominant market position. We have also identified weakness in that QL is essentially a price ticker, or in some instances, control. This probably explains its relatively low margin. We identified opportunities in its regional expansion into Indonesia, but we are also mindful of the growth constraints in its Malaysian market, cost inflation, and execution risk. Now, let's take a look at our forecast earnings. We project earnings to grow at a CAGR of 12% from FY12 to FY15. FY15 net profit will be 40% higher than FY12 net profit. market will contribute 60% to the growth in net profit from FY12 to FY15, while historically, Malaysian market contributed to the growth predominantly. Now, why is there a slowdown in Malaysian market earnings growth? Its Malaysian market is currently experiencing growth constraints in both poultry segment and marine segment. Its poultry segment is essentially demand constraints due to Malaysians are already having a very high consumption per capita of poultry products in comparison to its neighboring countries. Malaysians actually consume 320 eggs per capita per annum. On the other hand, its marine segment is essentially supply constraints due to its depleting fisheries resources, which is evidenced by the total marine fish catch graph. We project Malaysian market earnings to grow at a CAGR of 6% only from FY12 to FY15. Now, why is there a staggering growth in Indonesian market earnings? QL expanded into Indonesia in FY11. Since then, QL's business presence in Indonesia consists of poultry farms in Cianjur, marine production plant in Surabaya, and palm oil plantation in Kalimantan. All these key growth drivers will drive Indonesian market earnings to grow at a CAGR of 86% from FY12 to FY15. In addition to that, Indonesian market contribution to the group as a whole will increase from only 4% in FY12 to 19% in FY15. Now, we have projected Malaysian market earnings to grow at a CAGR of only 6%. On the other hand, we project Indonesian market earnings to grow at a CAGR of 86%. However, if we take a look at the chart, Indonesian market contribution to the group as a whole, in absolute amount, still remains insignificant. Therefore, to sum up, for the past years, QL has managed to deliver a net profit CAGR of 21%. However, going forward, due to growth constraints in Malaysian market, earnings growth in Malaysian market began to slow down. Indonesia will be the key growth contributor, but contributions remains insignificant. Going forward, net profit CAGR will slow down to only 12% from FY12 to FY15. Historically, QL's 3 years net profit CAGR also shows a steady declining trend, which further justifies our viewpoint of decelerating earnings growth momentum of a high base. Now, I would like to hand over the floor to Gabriel.
Thank you, Vivian. A picture tells 1,000 words, but nothing tells a better story than numbers. So let me tell you a story of numbers, our valuations. Since its listing in year 2000, the stock traded between 6 to 10 times PE. However, since FY10, the stock re-rated significantly and reached an all-time high of 21 times. It has since derated, and today it is standing at 16 times PE, which is still significantly higher than its historical trading band. As we project earnings growth to slow down, we see there's a further derating potential. The PB trend is also similar in that the stock derated significantly to an all-time high, and today it is coming down to 2.9 times, which is still higher than its historical trading band. We project ROEs to decline, and hence the PB multiple should also follow suit. We value the company using justified PB method. We use sustainable ROE of 17.5%, which is an average of our 3 forecast years, cost of equity of 10.1%, and also long-term growth of 5%. Using these variables, we derive a justified PB of 2.4 times. This translates into a target price of 275 ringgit, representing a 13% downside from the current share price. As a sanity check, we perform sum of parts. We apply the peer group's PE to our segmental forecast, and we arrive at a value of 280 ringgit, which is comparable to our target price. In addition, we also cross-check using PEG ratios. QL's PEG ratio of 1.4 times compares richly against its peers, as its PE is higher than its peers, while its growth is lower than its peers. To recap, QL is a good company and we see good growth prospects from its expansion into Indonesia. However, we project earnings growth to decelerate off a high base constrained by its Malaysian market. And finally, we find that the stock is overvalued based on our valuation method. It also stacks up richly against its peers. Therefore, ladies and gentlemen, we initiate coverage on QL Resources Berhad with a non-consensus sell at the target price of 275 ringgit, a 13% downside from the current share price. Thank you.
What are the key upside risks?
Sorry?
What are the key upside risks?
We foresee there are three upside risks. First would be higher than expected Malaysian returns, and second would be higher than expected better returns from Indonesian expansion, and thirdly would be a higher than expected dividend payout ratio. However,
Given a higher dividend payout ratio, which is not likely, is 100% of dividend payout ratio, also near to our threshold, which is 20%. As you can
What do
see,
you?
as you can see here, although 100% dividend payout ratio, it only can hit our threshold, which is around 20% of our.
it will still be lower than our threshold.
Can we talk about the management of the company?
Yes, basically the management of QL Resources Berhad is growth driven, mainly by recent can be evident by the recent expansion into in general, especially in Indonesia and Vietnam. And also, however, the company is growth driven and then it has a high gearing and a low dividend payout. However, going forward, we foresee the trend can be reversed when the company eventually reach a maturity stage.
Thank you. Presentation, you have not mentioned Vietnam anywhere, the growth prospects. How much is that applicable to contribute? Any reason for that?
Okay. Vietnam actually in the geographical segment, Vietnam contributes to less than 1% of the group's revenue, and while for net profit, Vietnam is currently suffering losses, although in a very insignificant level. It is mainly because the company has just started expansion into Vietnam and has only invested a minimal amount of CFA. These losses of Vietnam is mainly caused by the unexpected economic downturn, which we think this is unforeseen when the company decided to expand into Vietnam.
So what are the prospects for Vietnam in 2015?
We expect Vietnam, the economy will recover. So in that case, because there are low consumption, low of egg consumption per capita, so we expect there's a growth for QL in Vietnam.
However, there is a constraint in Vietnam growth because of the price conditions, as well as the supply is oversupply over there, and the demand is relatively smaller, is very lower. So we see the growth prospect is there, it will be recovered, but is there have a growth constraint in Vietnam.
Can you briefly explain how you come up with the projected growth rate in their net profit? The projected 86% growth in Indonesia and 4% in Malaysia. How did you come up with the projected? What's your assumption of that?
Basically, actually we project for palm oil is increasing 20% in mature area every year. So that's contribute 40% of the 55 million, 60% contribution from Indonesia. So it's mainly is contributed by the palm oil is because of increasing in mature areas. While the marines and poultry is around 10 to 20% with increase in production volumes.
6% is actually net profit CAGR for the Indonesian market itself, and the 6% is the net profit CAGR for the Malaysian market itself. In terms of contribution of the Indonesian market, it's 4% of the Indonesian market contribution in FY12, and it will increase to 20% in FY14.
The primary argument for implementing a sell of this company is deceleration in earnings growth, which you said will come down to 12%.
Yes.
How does it compare relative to the Malaysian stock market? What is the average market earnings growth rate in the market? Is it higher than the market or lower than the market?
Basically, they are no significant peers, no comparable peers for QR resources, which has three segments: palm oil, poultry, and also marine. But basically, as the stock as agribusiness in the Malaysia is trading at a higher PE multiples compared to the Malaysian stocks.
The growth rate of QR is actually higher than the growth rate in most agri companies in Malaysia also. They are having a very high growth rate, but it's just that we believe that the growth momentum is slowed down on the high risk.
And it doesn't justify the expectation of investors given such a high share price.
In fact, there is a revise of consensus earnings estimate of this company over a period of time.
Given that they are in the agriculture base for palm oil, soybean, right? I mean, a lot of that to do with the price. You know, if CPO prices go up, if the soybean prices come down, what is the sensitivity that that could change the whole earning profiles?
Basically, these are our sensitivity tests based on volume and margin. So the most sensitive segment will be poultry, which is ILF. So this one, 10% change in volume, there will be 6.5% change in net profit for FY13. And the least sensitive segment will be palm oil, will be 10% change in the volume will be only 1.3% change in net profit.
1% of changes in CPO price will only just affect the group earnings by only 0.3%, which is significantly lower than the poultry and marine segment.
But for your livestock, what are the key things that drive the changes in the margins? What are the key factors?
Rising feed raw material costs, this will cause margin compression. On the other hand, it is mainly control price commodity. Therefore, if there is an oversupply, it will cause margin compression issues.
In your slide number 9, it shows the CAGR 21% growth of net profit. And we can see from 2007 to 2008, it was very obvious improvement. However, the stock price actually spiked only in 2010. If you explore what was the reason?
The key reason would be, there are two key reasons for that. First, it will be the starting of expansion into the region, into Indonesia. So we believe that investors are putting a very high expectation on their expansion into Indonesia. And the second reason, we believe, would be due to economy downturn, where investors generally switch their preference to consumer stocks and hence giving a better market sentiment to consumer stocks as QL.
In the slide that you talk about growth constraints, can you show you have a brief explanation on the aggregate consumption in developed market as compared to the market in Indonesia?
By seeing this chart by comparison, we compared the egg consumption per capita per annum of several countries, especially in Asia. So Malaysia is currently having the highest egg consumption compared to neighboring countries, even the developed countries like Singapore. So while in Indonesia, which is another major market, soon to be a major market for QL, has the lowest egg consumption per capita. So we believe that by comparing this, Malaysia has already a demand constraint in the poultry consumption.
Following up from a previous question, the period from 2009 and 12 was also a period where the earnings really decelerated from a previous 3-year CAGR of 23 to 14%. But looking at the PE band chart, that was also the time when the stock really re-rated highly. Do you think there is a risk that that phenomena might be repeated again, that despite deceleration in earnings, the stock might continue to trade at high levels? Because of the reasons you mentioned, market's preference to attach higher value to consuming stocks, higher growth prospects of the region. Do you think that could be a risk for your recommendation?
I think there's of course a risk in our recommendation. However, looking at the very recent quarterly result, which is released yesterday, QL's achievement has only reached 60% of what the investors expect. And looking at the consensus numbers, which is they have been revising downward since 2 years ago. So we think this risk is minimal to our forecast. This is rising downwards since 0 time.
Could I know the reason when you chose your peer from the peers? You chose from Thailand.
Thanks.